Okay, so let me get going here. Now, what I'll do is actually, rather than me trying to watch for you to send me a message or something, I'd ask all of you to just make certain that you're on mute. And then if you do want to ask something, you just, go on off mute and then just ask me something because I've got too much else on my screen and I can't keep up with everything. So let me share my screen with you and we'll get going here. And then what I plan to do is there was a lot of questions. So what I plan to do is just kind of work through these questions and then take and as I work through these questions, take and answer what I think was a number of things I was going to do anyway today was try to review a few things, and then I'll go into the rest of the broadcast that I expected to do. So I think you'll be able to see this. I've got you on the whole screen right now, but I think it's fairly large so you can probably see it, and if you can't, just tell me. So there was one request last week for me to make a top 10. I started making a top 10. I got through 6. I'm sure there's others, but these are the ones that occurred to me, and I was jotting them down. And the first thing you have to realize is the best model you can create, and I guess I should preface this with, this is the third session now, or the third taping. We'll take a break somewhere in the middle. I'll do a fourth taping there. But and we're going to go over, of course, this crash course for the neoclassical model for anybody who hasn't seen the video yet, but I think everybody will have watched the first two. So going back to the top 10 here. The best model anybody can create is to create with the fewest number of inputs possible, fewest number of interactions within the model, yet you capture the most of it, right? And so when I built this model, I tried to find exactly that. What's the fewest number of inputs, the fewest number of interactions, and make no exceptions as best as possible, and capture the majority of what I was trying to capture, which of course is the price action, being able to trade the market successfully. And I think I did a pretty good job of that. It's not perfect. I mean, it doesn't capture everything, but it does capture most things. And so when I was asked this question of top 10 concepts, the model doesn't have a lot of things. I mean, if you think about it, there's like retest regen, there's the 6 bar stuff, that, the magic number being 6, there's the breakout retrace, there's anchor bars, there's like, maybe 10 things. There's not a lot of stuff. And so, what are the top 10? Really, it's kind of hard to choose because the top 10 is almost the whole model. But anyway, as I thought about it, when I wrote the third book, I realized that retest regen was much more important than I thought it was when I first discovered it. And so just so that we can kind of stay on the same page here, I'm going to pop up a retest regen and kind of just go over these concepts as I do them, and then I'll go over questions where a bunch more folks have asked the same question. So I'm going to expand this so that you'll be able to see it better. Retest regen. When you break a swing point high, because there was a question about this, when you break a swing point high, and here's the H, that tells you it's a high, and it gets over it, the arrows tell you when you're breaking something. So in this case, you can kind of see this arrow right here is a break of that high. And if you can't tell, you can just hover over it and get the numbers. 211.05, this break here is 212.13. To break it means you have to get over it, you have to stay over it at the close of whatever the bar is that you're looking at. In this case, we're looking at daily bars. And so when it gets over it, this bar, the little red arrow that you see where my crossbars are, and this high over here, when it gets over it, it stays over it. The retest regen becomes effective immediately. And what that means is that the first thing you should think of is that, okay, I've broken a swing point high, I may or may not have transitioned, I may have just reaffirmed trend, but now that high of that swing point high and the low of that swing point high becomes the retest / regenerate area. And all that means is that when price comes back to this area, right, depending on how it comes back, you should expect the buyers to try and buy it. Now, the thing I discovered was that if you go over this, as we did here, we went over it on June 7th. On June 8th, we stayed over it. We did not, the low of June 8th did not touch the high of that swing point high. So that's one bar past it now. Then the next bar is the second bar past it. But as you see, it got back into it. So it got into that swing point highs bar again. That's the beginning of the retest regen. Now, the thing that you want to see, if you were wanting to buy this, what you want to see ideally is you want to see it go over this and stay over it for 6 bars before ever coming back. Because if it stays over it for 6 bars, the probability that it's going to break through the low of the swing point high is extremely low, something like 8 to 10%. And so it's a very high probability that it will at least bounce out of there on the first attempt. And so anytime you see it go over, stay over it, when it comes back to it finally, if it's more than 6 bars, your probability is extremely high that you can just almost blindly buy it. Now, where would you want to buy it? When it's over it for more than 6 bars, the odds are high, and I don't know exactly what the probabilities are because I didn't do the data on this, but anecdotally, the probabilities are high that we'll only get into about a third of the bar. So it will kind of almost like this one did on June 9th. It'll come down a little bit of ways, and then that's where they'll start buying it. So in other words, if you get up here, you stay up here more than 6 bars, when it finally comes back in, it's only going to eat up about a third of the bar. Now, when it's a wider bar like this, a third of a bar is significant. When it's a small bar, it's just barely going to touch it, right? Because there's not much room. But that's kind of what I've observed. Again, I don't have data on that. I never went back and did the analysis once I started observing how far it would come into it. Now, the analysis that I did do previously was that, and actually did the data, was that the odds are very high when you come back that you're going to get a bounce very quickly, and that you can almost blindly buy that thing. Now, the only time I've observed, and it actually happened fairly recently, is that when you do that, blindly buy it, the times that it fails, that 8 to 10% time that it fails, typically happens when there's a strong move taking place in the market itself that's opposite of what you're doing. So in other words, if the market was moving down hard, and in this case we're looking at the market, the S&P, if we were looking in the case that I saw recently was Apple had broken down, and I could pull the Apple chart up and show you actually. Apple had broken down, AAPL, and when it did, here's the Apple chart. So let me see, where's the swing point low? There was one that got broke. I'm trying to remember. This was a different case. This wasn't the case I was thinking about. Yeah, I was playing a different trade here. I think if I remember right, I was playing it when it came back into this big bar. I was trading it short, which was a different case. So anyway, we can just stay on the Apple chart and continue the discussion. In this case, we have a swing point high, for example, right here that's broken. So on Apple, we'll just make a new one here. This is a swing point high, and now we're coming back in to test it on a breakout. Now here's the more than 6 bar case. So on Apple, this is the case I was just talking about. There's a swing point high on May 4th. When it gets over it, it does not come back within 6 bars. In other words, you're over it now for about 15, 20 bars, it looks like. And it finally did it on Friday. Now, the thing that we didn't talk about yet, we should talk about, is that when it does come back, one of the reasons the retest regen is very valuable in terms of a tell is because you're collecting more information on the retrace than you would have collected if you bought the breakout. Okay, and there was actually a question about when would you buy breakout, and I'll get to that in a minute. But in this case, if you look at the volume on this retrace as it comes back, volume is 60.5 million shares. The breakout bar, and let me put this back on the screen for those of you that can see it. The breakout bar, when it broke out, it was on the 23rd, didn't come back. The volume on that bar is 37.8 million. The volume on the swing point high is 40 million. So what you want to do is you want to use the worst case scenario, which is the 40 million, in other words, the highest volume. And when I come back, I want to see if I'm coming back with more volume or less volume. Now, this is, again, this is kind of the 90%er. This thing should at least try to bounce, and it shouldn't get much more deeper than it already is. That's the probability side of it. The thing that tempers that probability is the fact that it's coming back with increasing volume as it's breaking back into this bar. So, when I look at this chart, could I buy Apple? Sure, I could on the 90%er, but the two cases, the cases that I've seen that tend to fail is when the volume escalates on the way back compared to the breakout bar and the swing point high bar itself, taking the highest volume of those two, and it increases significantly, when in this case it did, then it makes me less desirable, to buy. As a matter of fact, if I'm going to buy it, what I really want to do now is I want to see it get almost to the bottom of this area. And it just so happens that there's also volume at that same area here. If I look at April 28th, the low there is 94.25. The low here is 94.19 on the swing point highs low. So somewhere down in that deeper area is probably where I'd want to buy it, which happens to be where the green shows up to, the support zone. So as it comes back into that area, right, most of the time, and even here, it should try and hold this area. In other words, this is what you're always looking for, is the ideal case. And this one's probably not ideal because it actually has one little bump on it. It's got a wart, and that's the higher volume coming back in. But I would be very surprised if they just break it down without some sort of an attempt to bounce it back up. And so as it comes back in, if it were me and I really wanted to buy Apple, I'd be waiting for the little support zone that's down here just over 94 up to about 94.25. And that's where I would be focused on trying to buy Apple, probably Monday morning if it happens. So that's a retest regen. And so we've talked about two or three things here. One is, if it's more than 6 bars, the probability of it actually regenerating, attempting to regenerate, and that was another question. Let me do that one as well. So when I'm taking Apple again and I'm looking at that same swing point high, and that high was 95.90 on May 4th. When I say a retest regen, what that means is it gets over it, it comes back into it if we're talking about a bullish one, and then it is going to get back up above that high. When it does, the swing point high that it came back into, when it does get over it and close over it, now it's attempting to regenerate. And at that point, the test has taken place, right? It's tested whether or not it's going to regenerate, and it's starting to push back up and in regenerating. Then the question becomes totally different. It's not a question anymore, will it regenerate? Because it is. The question then becomes, how far can it go? And then you have to start looking at other things. And in this particular Apple chart, the first thing that you would look at is you would take a look at the any kind of anchor bars that are out there that are going to give it resistance. And in Apple's case, the May 27th and May 28th bars are going to be the area that's going to be tough to get back over. And actually, this is interesting. Apple actually, and this, you'll see this a lot of times too, Apple actually has another retest regenerate which again is a negative for anybody wanting to buy it because it just broke a swing point low. So you've got a retest, regenerate bearish that's on this swing point low that's from June 2nd. You have a swing point high that was broken now. It's doing it for the first time. So now that I look at it even more, right, as I'm talking to you live, I'm even less thrilled to try to buy it because now I've got to break over this swing point low, which lines up with these two big volume bars over here on the breakdown area. This just looks like a garbled chart, and the odds of making a decent sized move, that warrants taking that risk is probably not there, because you want to get your risk rewards. If I were to, and this is another thing, money management, if I wanted to buy this, where am I going to buy it? Where am I going to put my stops? Right? If I looked at this and said, my stops, if I bought Apple around the 94.25 area, I'd probably use I would have to either use the bottom of that zone, which is the retest regen zone, and that price point is 93.82, and then I would add the ATR, and the ATR for Apple, I don't know exactly what it is, we could look it up, but let's just say it's $1.25 or $1.50. If I took 20% of $1.50, which is what, 30 cents, I think, and 30 cents, I would add it to the bottom of this bar, which the bar on April 4th is 93.82. That'd be about 93.52, and then I look to see what's significant around 93.52, and I see a high here of 92.78 that has volume. There's really nothing else, so I'd probably just use about 93.52 and put my stop somewhere down there. There's not a lot of reward compared to the risk. I mean, even if I got it at the best point, I'm giving it very little slack. And as you all probably realize already, if I gave it 50 cents, odds of getting hit at 50 cents are pretty high. If I give it, say, $2, odds of getting hit at $2 not nearly as high, right? So anytime you put your stop extremely close, you're increasing the probability of getting stopped out. And so ideally, you want to be able to find something of significance, be able to get under it far enough. Like in this Apple case, the only bar on the downside after this retest regen zone is the high of the May 12th bar, which is about 92.78. So I'd really try and get somewhere inside that bar. It really shouldn't be able to get into that bar. And if it does, it's going lower. And so, if I do that and I put the bar, I put the risk at, say, 92, 65 or something. Now I've got risk of about $1.50 or so. And what's my reward? Well, my worst case reward is these two bars from the 29th and 28th. They overlap. So I don't have a lot of good reward risk. So it's just not worth the trade. And so something like that, I just pass on. I go find something else. So let me try to review what I was doing, though. Retest regen. More than 6 bars, higher probability, very high probability. Less than 6 bars, it's only about a 62% probability it's going to regenerate. 62, 68, depending on what it is. More than 6 bars, it's usually in the 90 percentile. Now, to regenerate means it could just bounce out of here and then come right back. Doesn't mean it's just going to continue on. It just means it's going to be able to hold that area and get back over the swing point high that it got back into. It could just get over for a bar and then back into it, or it could be the start of something larger. And when you're looking at the Apple chart, for example, in this case a buy, the Apple chart's kind of negative right now. That's, we haven't even talked about adding in the other factors. For example, trend now is down, not up. If we move this to a weekly chart, you're going to see the same thing. Trend is at best is sideways. And if we move to the that was why now it hit me why I thought because I actually traded Apple and lost money on it. It broke on multiple time frames, and I'll get into that in a second because that was the other thing. But on the trend on this time frame, on the weekly time frame, that one's sideways at best. More or less down, right? I mean, we actually broke a swing point low. We broke a swing point low, and when we break that swing point low, we actually were already bearish. And so this is bearish on this time frame as well. And when I go to the monthly chart, you're sideways. And you can see that with the arrow, and that really is the way this one looks, it's sideways. So Apple is in a downtrend. You really don't want to be buying something in a downtrend most of the time, because if you do, A, your timing has to be really good, and B, it probably is a trade, not an investment, not something you can keep longer term. And so one of the things that I found was that the retest regen sequence is very important, and it's also important from this ideal of a warning sign. And so many times when we're looking at trades, we see, and I'll go back to the Apple chart, we see that trend like, let me find a case with Apple. Swing point high. Let's find a break. This case here. So the swing point low, I'm trying to find a case where it's a warning sign. I'm not going to go over it again. The next piece of it actually kind of played into, in terms of the top 10, played into the same thing. That's the 6 bar concept. The 6 bars makes a big difference. You know, 6 bars is used for counting when you're looking at charts in terms of finding a swing point high and a swing point low. And there was a little bit of confusion about that. And since I can use this now, the presentation assistant, I can actually show you. If we're trying to find a swing point high, we just find the highest high somewhere, starting at the left-hand side of the chart. And once we find it, we just look at the next bar and say, does it have a higher high or not? If it doesn't, we go and we keep counting. So this is bar 1, bar 2, bar 3, bar 4, 5, 6. As soon as the 6th bar prints, that potential swing point high becomes actualized. It becomes real, right? And in the charts, it actually gets an H. This bar was the bar that we stopped on. That was the 6th bar. That bar now is the potential swing point high going forward. The next bar is higher, so we just forget this bar and we go to the next bar, and then the next, and we keep going until we get a high that it stays, and then we go 1, 2, 3, 4, 5, 6 again, right? And eventually you're going to get 6 becomes a swing point high. The low is just the opposite. It's the same thing, just in the opposite direction. You find some low, and in this case, you know, like I told you before, the TA Today charts actually keep track of everything over here, but in this case, this actually was a low. You can see the L at the bottom of the chart. The L will get printed at the top of it. So, you know, there's not enough room down here sometimes. And so, you know, 6 bars, you have a potential swing point low here, and you go 6 bars, and that becomes actualized. And then that 6th bar becomes the next potential, and you keep going until you get another low. And then it does it again, 6 bars. And then this one becomes actualized. It's not only 6 bars after. When you're doing the retest regen, and, you know, when we were talking about early warning system, the whole idea with the retest regen is when you break something, like in this case, when we break this swing point high right here on that arrow, if we come back and we test like we did, actually right there's a little bitty test of it within 6 bars. If we actually get underneath this low of the high on the swing point high and stay under it, it's an early warning system that the trend is about to change, or at least attempt to. When you get under and stay under a swing point high's low, right, it's at that point that you potentially are going to get a trend change. And it's an early warning system that that could happen. And that you can see here, we got under it on this bar. Now what I like to do myself is, even though it violates it, I like to see 1 bar confirmation. That gives me more confidence that it really is, you know, not just an oddity, but it's probably for real. And that's what I usually look for. So in that swing point low, or this swing point high is low, looks like Max didn't come on though. You there, Max? Yeah, he did. Yeah, perfect. Okay, everybody's here now. And I think everybody can see everything now, and they can actually see the presentation assistant now that I have bandwidth. So I was showing this. That's a retest regen. You get over it up here. You actually test it into it within 6 bars. This is the second test as it comes back in again. And then the third test. And the probabilities get lower and lower that you continue to regenerate. You actually got under it here. If you got one more bar, it's an early warning system that you're probably going to break a swing point low somewhere in transition trend. And in this case, you know, we didn't. We already transitioned once before, but a lot of times it's an early warning system. So it will just save you from sticking around, you know, on a trade when the trend is starting to change on that trade, or when the trend looks like it's about to change. And so it's kind of an early warning light for me, and that's the way I use it. But the whole idea of retest regen is testing, right? You want to see the test. You want to see how they play out. You want to see what the volumes look like on those tests. And when you do that, I'm going to go to Russell here. When you do that, you'll get a good clue sometimes that something's about to change on you. And I was looking on Russell to see. I thought there was a good example here of one. This one didn't do it either because the markets have been pretty bullish lately. So anyway, top 10, going back to this, retest, regenerate, I think I've explained it enough. 6 bars, your odds change tremendously. Breakouts, they only make sense if they happen simultaneously on multiple time frames. And I'll go back to the Apple chart to show that, because I had talked about that I traded the Apple chart specifically on that reason. Let me go to my tech stocks. It'll be in this one. These charts are all shared. Somebody asked about watch list. I'll touch on that, I guess, when I get to the question. But if I redraw this, it'll be big for you, I think. Well, maybe not. Let's redraw it so it's bigger. So on the Apple chart, there was a break on multiple swing points. And usually when that happens, and I've got the daily and the weekly up here, usually when that happens, and it happened right here, this break on May 9th was also the break on well, there was, you can see with the arrow here, there was a break of the same on the same week. Yeah, it was this break. So the break on the week of the 9th, right here on the Apple chart, was simultaneous to the break on these 2 bars on the daily. And so when you get multiple breaks on multiple time frames, that itself is a high probability of continuance, especially when it's a break to the downside. And so when Apple did that, I actually traded Apple and tried to, you know, go with that trend, expecting it to continue, but it didn't. And so that 90%er actually failed. And typically when those happen, it either has to do with volume or it has to do with the general trend being against you. And so if you're trading Apple short and the general trend of the market is higher, which it kind of was, a lot of times, not a lot of times, but that's the times that I see those 90%ers fail. So when do I buy a breakout, either to the top side or the bottom side? I usually do it almost exclusively, only do it when it's on multiple time frames like this. And I happen to be showing you one that actually failed. But that's when they take place. I think this one up here was an earlier one that succeeded, October 5th. That was a break on multiple time frames too. This one actually succeeded back then. This is on the weekly. So you can see the break here, and on October, we don't have it on the chart here, but back then it broke as well on Apple on the daily. That one you can see the kind of carry through that took place, and you could see the target was down here, right, the big high volume wide price spread bar. and it goes right down there and tests the target eventually. Almost got to it here, got the big bounce, comes back up, does another retest of this retest regen. You see the retest regen here off this low. After more than 6 bars, it actually got all the way to the top of it, and then it regenerates lower eventually. And so these are the kinds of things that you see play out over time, and they do respect those areas, and a lot of times, or most of the time, those areas end up having significance for whatever reason, and I can't explain it. Some of them I can hypothesize, but a lot of them I can't explain, but they do tend to work over and over and over. In the Apple case, this recent break of the low, yeah, actually no, that case is dead now, because not only did it break the swing point low, but it got over it for more than a couple bars, right over that swing point low's high. And so the retest regen, as it came back, and I'm on the weekly here, right? It came back within 6 bars, and it got over it and stayed over it. And so that more or less tells me that Apple right now is probably a range trade, right? It's a sideways type trade instead of a breakdown case. Could Apple eventually go lower? Sure. I mean, the next setup could, and it could set up to where this is a swing point low, this low, and it breaks it again, right? I mean, we could do the same thing, because we're already 1, 2, 3, 4, 5 bars, right? One more bar and this will print as a swing point low. And this will be a swing point low over here as well, and a break of that area could send it down again. It's a different setup. Well, it's the same type of setup, just farther out in time. And it really isn't a break. Once that swing point low breaks, you can't break it again. It's already broke. I think that's the key thing. So once the break takes place here, it's already happened, and it's not going to happen again. It's going to have to be a new swing point low that prints that happens. Does that make sense? So it's still, the Apple's still in trouble, and Apple can break farther down, but it's going to be off a new swing point low if it does it. And if it did, I would be looking at potentially buying the breakout one more time to the downside, shorting it. But Apple's probably not my ideal place to be shorting, because Apple is such a strong company. The odds of it going way down, like, some company that's kind of a fly by the night that's had a huge run or something, and then all of a sudden they start breaking down, like some of those, the ones in the robo, like, actually one of them I like is PANW, but some of these stocks, right, they can get huge moves to the downside. And like this one's testing again. Palo Alto Networks is one of the stronger ones in that group, but these stocks, they have such high PEs. Apple, I don't think about fundamentals all that much, but I don't ignore them. Apple's PE is like maybe 8 or something, right? I mean, it's not that high, whereas these things are probably 100. And I haven't shown you that, but if you go over to here on TA Today, if you go to the, I'm going to try something else here. You tell me if you can still hear me. I'm going to set my mic back down. Can you still hear me well? Everybody, you okay? What's that? Okay. Well, let me take him. I'll hold it up, because I don't have my mic stand with me today. If I go back to the tools, go to the trading cube, I do keep, and you can find this everywhere, you don't have to do it on my site, but I actually do pull these things in on most stocks that I can find them automatically. Apple's PE is what, 10.9? And then if you go to something like that PANW I'm talking about is PANW. I imagine this guy's 50 to 1 or something. Yeah, 49, right? It's almost 50. And so, these guys have such, I mean, they're based on growth. And if you don't continue to get big growth out of these, they're high flyers. They're going to come crashing down. And so, a stock like this, a break of multiple swing points to the downside, yeah, there you can get a big move. Apple, maybe you get $5-10, but it's not like Apple's going to move very fast, very far. Now, the other thing we didn't talk about is that when you do break and you buy a breakout, either up or down, it usually carries 2 to 3 bars. And you'll hear me say that. So if this breaks, and if it's breaking on multiple time frames, and I haven't looked at it, but let's just assume it is, we could actually pull this up and see what it looks like over here on the weekly. And no, see, the weekly's not set up that way. It would be much farther down, but let's just assume it is. If it breaks here and it was multiple time frames, you can expect it to go 2 to 3 bars deeper on the longest time frame. So if this was, let's just say this is a swing point low here and it's breaking this one too, you would expect it to go 2 to 3 bars on this time frame. Okay, so that's another measurement tool you can use. Now, 2 to 3 bars doesn't mean it has to just go straight down, because my algorithms, when I did this check of all this, I didn't really say, does it get lower lows each week? I said, does it not get back up into this retest regen area? That was the algo that I was applying to it. So if it breaks, you don't expect it to get back into the low of the low for more than 2 to 3 bars on the longest time frame. Okay, so that's what that is. That's the other questions. Breakouts, they make sense on multiple time frames. That's the only time I buy breakouts. Most of the time I'm buying retraces. Almost everything is a test, but the value of the test depends on testing something of significance. This gets back to and we can use this one as an example. It gets back into another question that we're going to hit here in a bit, which is anchor bars. Let me quickly review the anchor bars one more time. Anchor bars come in 3 flavors. The easiest one is the swing points. Anytime there's a swing point, that swing point is an anchor bar. What you see on the chart, the blue ones, are ones that actually got used for zones. It doesn't mean these other ones, like this one, because it's not blue, it doesn't mean it's not an anchor bar. It just didn't get used for the zone. It doesn't mean that it's not an anchor bar. It means that it didn't get used as a zone, right, for the zone that was drawn. And so any of these swing points are anchor bars. The other types of anchor bars is anything that's high volume. And the question that had to do with the high volume is, if I take the volume on every bar and I take the size of those and I do an average of them and find out what the average is, those bars that are going to be high volume are going to be 1.5 times. Oh my God. I'm so sorry, guys. I really don't have anything else to do with the bandwidth. I'll try to keep the mic as close as I can, and maybe I'll just slow down a little bit. But each time you get each of the 60 bars, if you take the average volume of them, multiply it by 1.5%. Any bar that's going to be a swing point, that's going to be an anchor bar on volume, has to be greater than that amount, whatever that amount is. The wide price spread is exactly the same thing, just having to do with this spread between the high and the low of the bars all across the chart. So if the wide price spread average is 40 cents, then I need a wide price of 60 cents on a bar to make it a wide price spread bar. And then the last thing is, I'm sorry, yes, that was what you actually said in your email too. It's 1.5 times. And so if it's more than 1.5 times as much, then it's a candidate. You only take the top 6 with the widest price spread, and then those 6 become anchor bars. And that's true of volume 2, 1.5 times as much. Okay, and so those are anchor bars. And I got onto that because, test. A good example of a test here, there's different types of tests. One test that's going on here right now is a test of swing point lows. There's a swing point low here on Pan W at Palo Alto at May 13th, at May 27th, and those two are both being tested. The low here broke one of them. You can tell that immediately because you have a green arrow. You can also tell immediately which one because the volume here is huge, and the fact that it's a green arrow tells you the volume on the bar that did the breaking is higher than the volume on the bar that got broke. And so I can immediately tell it was this bar that was broken on May 13th, 1.58. We broke it with 1.956. So this bar was broken, but this one wasn't. So what does that all mean? Well, the test of this swing point low was successful. In other words, was a failure. It actually, in failure and success is hard to use. I usually try not to use those terms because it depends on how you're looking at it, right? Whether it succeeds or fails. So was it able to break it? Yes, it was. So from a bearish point of view, that's a good thing, right? But it was also testing this one. And the test of that one, it got under it, back over it, had less volume. That says that it's probably going to try and bounce. You know, if you don't have the volume and you can't stay under it, you're probably going to try and bounce from there. Now, how far can it get? Well, then you look at other stuff, because there's other tests on the way back up. For example, now, because this bar is a anchor bar, a test of this top on this big high volume bar is going to be a good test. In other words, I could expect it to maybe bounce up to there, but when it did, I would also expect that's where the sellers would want to show up again. And if it gets up there and gets over it, then something has changed, right? Some dynamic has changed. And so you're using these kinds of bars of significance, and they're always anchor bars. You're using those to give you an idea about whether anything's changed or what you see taking place, mostly here, which is downdrafts, is still in effect, right? Because the overall trend is what? It's down. And if we looked at it on a weekly basis, and let me pull that one back up. That one's sideways right now. Actually, it's down. It's negative as well. And so the downtrend, you have to continue to believe in the downtrend, because you always, anytime you're going to take a trade, always ask yourself, what's the trend on the time frame I'm expecting to trade? If I'm going to trade on a weekly, what's my trend? It's down. I usually want to be short if I'm going to be trading it. If you don't, it's always just a fast trade, because your timing has to be good against a trend. The reason I say that is the trend will typically bail you out. Are others having the same audio issue? Is it just the one? Okay. Well, I don't have, I have earplugs in to hear you. I've actually got a mic that usually I record with that usually is pretty good, that I'm speaking into. I'm not sure why I'm getting the audio issues. Maybe it's, yeah. Well, if I break up, just see if I come back pretty soon. If I break up and don't come back, then certainly tell me something. I think the main thing is I just try to slow down. So when I do break, Huh. Well, you're making my engineering mind work, but I don't know the answer. Yeah, I don't know. Yeah. So maybe I should take a breath every now and then, huh? Okay. And I said that facetiously, but also seriously. Let me pull this back up. Okay. I forget what I was talking about. Or I had a point I wanted to make it, but I forgot what it was. Oh, the trend. You want to trade with the trend, and the reason for it is the trend will typically bail you out. Even if you get a bad entry, let's say that we're shorting this, and let's say I'm smart enough or dumb enough to sell it right here because I just broke a swing point low. Even if I'm wrong, more than likely when it gets back up to here, those sellers are going to reappear. And if that's true, and I just stick with the trade, probably it's going to break down again. And so the trend's going to bail me out, or at least it's going to get me, reasonably close to, get out at even or something. If I trade with the trend, right, that's the case. If I trade against the trend, of course, is moving against me. And there's some data in the third book that talks about what the probability, the effect is of the general market and the effect of the sector on your trade, on the trend. And I'm going by memory here, but I think it's something like 2 to 6% or something on one and 2 to 5 on the other in general. And so it's a fairly significant effect. So when the first thing you should always ask yourself is, what's the trend when you want to make a trade? And you should do that from the perspective of the trading cube. If I'm going to trade, I don't think this one will blow up actually. If you're going to trade, and I've got Apple up here. If I was trading Apple, I want to be trading with the trend, ideally on the stock, the sector, and the general market. At least I don't want to trade bearishly on Apple if these are bullish. The sector and the general market. You're kind of asking for trouble because these are going to be working against you. Now, when they're sideways, yeah, you can do it. If they're bearish, it's even better. But you don't want to typically trade against the trend on the time frame that you're interested in on the sector and the general market. You would prefer them all to be together. And so some of the best shorts, if you think about the market over the last 2 years, where were some of the best shorts? The basic materials, energy, right? Because the sectors were weak. And so many of those stocks just got decimated. Now, when do they actually become very profitable? Well, when they get so oversold, you can get huge bounces out of them, which is kind of what we've seen in the oil sector in particular. Or if there's really a change taking place. And I think somebody asked me about gold. And I'm going to put it up here. Which is one of those things that is slowly, it looks to me like it's slowly making a large transition from bearish to bullish again. And I almost need a monthly here. I'll switch the weekly to a monthly and switch this to a weekly. The reason for that is, and I think I talked about this last time, is that on the longest term time frame, which is the time frame that has the least amount of noise, and out of curiosity, with me taking kind of pauses, is this better? Audio? Yeah, okay, because I'm trying to take those pauses, so I sound like I don't know what I'm talking about, but I'm purposefully sounding stupid. When it got over the swing point low and held for a bar on the longest term time frame, that is a very good sign, right? Because this trend typically doesn't change very often. And if you look at it, this is 5 years. This thing has been bearish now for this long, right? Which is, what, 3 years almost? The cycle typically is 3 to 6 years on monthlies, on anything. Some things have a little bit different, but most of them are about the same. And so gold is finally starting to attempt a massive change, right, over a long period of time, which is the monthly. And it's supported initially on the daily, then the weekly, then the monthly. And so that's when you'll see, the opportunity for large moves, right? And that's where you have to try. You're not going to identify the bottom, right, because it won't change that quick. You can start to think about it on the intermediate term time frame when it starts to show you something. But it's really when it finally, the confirmation comes when it finally does it out here. And in my opinion, it's basically done that already. And so I think, here's an example of a sector that initially, if we had gold up, and maybe I should pull gold up. Yeah. Sure. And I'm going to pop it up here so we can see all the time frames. I have to redraw them so they're a little larger. The reason you don't see it on the weekly is because you've only got 60 bars. Doesn't mean it's not there. So if you remember, I said sometimes you'll see the you'll see breaks of swing points, and you won't know what they're breaking because they're off the chart. And so the fact that you don't see them doesn't mean they're there. They are there on the weeklies. You just won't be able to see them on the chart because we're only looking at 60 bars. So it doesn't really, matter of fact, the reason you're always looking at the 3 time frames is because this time frame will show you what you don't see on this one. And the reason we use 60 is to keep it simple so that you don't get overloaded. So I can quickly look at this and know that there's resistance up here as well on the weekly, even though I don't see it. Okay, so what was I going to say before I digressed? I was going to show you, I wanted to show you this. So when this began to change on the daily, you would have had bearish out here on both of them, and you still have it on the monthly, but it would have been here. So you can't take a bullish position in the daily and know with any confidence that in fact the big turn's coming. You just won't know that. You'll know it, the first you'll know on a major turn is on your intermediate. That's when you'll first be able to identify it. And as I think we talked about last time, that identification came when this one started. First it got over swing point low, retest regens. then it eventually started breaking swing point highs, and that's when you get trend transitions. And then, most importantly, you had volume escalation, and it held on the retraces. That's when you know something's really going on, and that's when this bars started changing over here. You get over the retest regen as well. That's how you start catching a big turn. So you're not going to catch the bottoms on a big turn. You may get lucky, but because you could have thought this was a bottom, that was a bottom. You know what I mean? You don't know. I gotta slow down. Yeah, so you just have to, give it time, and then let it get over something, and let it stay over something. Matter of fact, well, yeah, you're talking about D6, right? I don't know if that's as significant to me as the fact that this right here, the retest regen, that it got over it and stayed over it. That's what's significant. In other words, each test back into this area keeps getting bought. That's what makes it significant, not the fact that it's 6 bars after the low. The other piece here, if you look at this, remember I was just saying you really want 1 bar of confidence after a retest regen. Here you get over it. You see that? But then you're right back into it. You really would like to see a couple bars, right? The one that gets over it and one more to tell you it's real. And so when you're looking at these, you have to allow a little bit of, slop, if you will. That, I'd like to see 1 bar to give me the confidence. You can jump that, but you have to realize you may have to just bail back out because it may not be what you think it is yet. A couple bars, if they don't bring it back, then it's probably real. So anyway, gold, very bullish. It's at a point now, given this bearish engulfing, that I think it's going to take a rest again. But again, I think it's going to hold this general area and going to take off again. As a matter of fact, I don't think it's going to get as deep this time. Maybe about 117 or so. Yeah, about 118, 117 is the ideal spot now. Okay, let's go back to the questions. Otherwise, I'm not going to get through all of this. I think another major thing is once you start to think about trades as just 2 types, it simplifies everything. They either break out and there's probabilities associated with that, or they retrace, and when they retrace, there's probabilities associated with that as well. And ideally, the retrace is the better one. And the reason is because it gives you a lot more information. Let's take this as an example. I'm going to take gold on this swing point high break. Okay. Here's the breakout. Got volume, right? The green bar. Gets up, more than 6 bars, retraces, does the test. What does it do? It immediately bounces out of that. That's exactly what it should do. Now it does come back down and breaks it, and we're on the daily, which has the most noise. When it does break down, then it tests another one, right? It does some tests of some other stuff. But the ideal here is that it did what it was supposed to. When it does what it's supposed to, this could have just regenerated higher. That would be the ideal, right? It didn't. But that is a factor of how far and how fast it moved, which actually we haven't talked about. Let's do that now. One of the things you're always doing is looking at the angle of ascent or descent. an angle, and actually that should probably, when I think about it, should probably be here. Another one of those important things I learned. I'm going to put it in here so I don't forget. I'm not talking. Yeah, I'll save it later. So the angle of ascent, anything more than 45 degrees is not sustainable over time. That's just not sustainable. And the date, Feb 29th, is right here. No, it's April. Feb was over here. It was over here. And so this pullback, let's keep doing the angles. First it looked like that. Then it looked like this, right? Then it was even, right, continued like that. Then it went as low as here, more sustainable. But now it's back up here, right? Those angles just aren't sustainable over time. It should be something like this. Two ways to solve it. One is you just keep going sideways for a while, right? Maybe you're doing it with this kind of up bias, but you're working off this big move. So that's, the angle of ascent tells you that you have to be patient, right? Because if you think about that here, look at your angle here. Still steep, but not nearly as steep as it looks over here. Well, I guess a little bit, but not quite as much. Just needs time. Just needs time to work it out, get it more sustainable, right? And base building, they call it. And then you can make another move up. And so these long-term turns, it's hard. I think I told you before, it's really hard to stay with something that's going to take 2, 3, 4, 5 years. It's just really hard to do that. You know what might work is every now and then somebody turn on their mic and just, that way you'll grab the channel and just turn it back off. Maybe one of you just select somebody. We'll let Chuck do it. So every now and then just, 5, I don't know, when I start getting choppy, turn your mic on and off. I think that will solve this issue. You're elected. Okay, so that angle of ascent's important. When you see a steep angle of ascent, you have to expect, even in a bullish market, you have to expect at some point it's going to give you a retrace. Now, when you're doing trades, you can either just, if you're really comfortable with this, you can just stick with it and just ride it out. The fear is always that you're going to lose some of that money. And so for me, I don't do that. I usually take some off, put some on. And I'm buying the ebbs and flows. And so when I look at gold on this move right here, this bearish engulfing, I expect it to trade back to something, in this case the swing point high, which it did the next day. And then at that point, you could either short something or you could take some off. And in my case, because I want to be in a long time, I actually just sold some GLL, which is the opposite. Or not sold it, I bought it, which is shorting it. Just as a counter trend trade. And I expect to try, this is the opposite, it's a 2-to-1. I expect to either sell some in here, right? Or maybe a little bit higher up, maybe into this bar in this area. And it's just buying time. Now, if I'm wrong and this just continues down, I will lessen my profits. And when I do this, depending on how bullish I am on gold, I have to measure how much of my profits I'm willing to lose. You know what I mean? So I might short, say, let's say right now I actually have about $250,000 in gold. I shorted about the equivalent of about 120. So I've shorted half of my profits. If I'm right, I'll be able to take this off, make money, and buy more gold with it. If I'm wrong, I will end up losing some of those profits as gold continues to just go up. And I have to be willing to do that. Short, always short, daily time frames. My trade on the GLD, I expect it to be years. Yes. And so I will trade around it only at key points. And again, if you're trading anything against the trend, right, and this is trading against the trend now to take something short on gold, you have to have good timing or you will lose money because it's working against you. And so I'm taking a key event and saying, you know what? I don't think it's going to get much higher than here. I'm going to short it here. I'm going to try to buy it back either there or a little bit lower, maybe back into here. All right, I don't know. I haven't really done the numbers. I just actually the key spot here now is this bottom. You know, if I get under this bottom, I may try to stay with it a little bit longer. If I don't get under this bottom, I'll probably just take it out and make very small on it. But if I get under it, then this bar is the next significant bar, which actually, if you look at it, guys, that lines up, doesn't it? So I would be shooting for this area here. And given that I'm counter, I would be very careful and I'd take it out wherever I could on the way down into this area. But then that allows me to cushion the blow right on the pullback so that I can keep building that position bigger over time and not give it up. Because typically what happens is you tend to find yourself, you know, and I know you've probably done. Yeah, so when my audio fades on one of you, just go ahead and come in with your mic and go out. And let's see if that does it. Keeps me from doing that. What I was going to say is when you get these big spikes like this, you and I know we don't sell the spike usually, right? We end up selling somewhere on the way back. Like this one, we probably sold it there. You know what I mean? If we had a big position because we don't want to lose it. So rather than do that, you know, I tend to say, okay, if I'm wrong, I just ride it out. But if I get a chance, I short some on the bounce. And then, you know, because I think now these, and I think I told y'all this, these wide price spread, heavy volume bars like this, it will tend to hold price now for some period of time. And so you want to use that, right, as a place to trade around this position. Maybe buying your short up towards the top if it gets up there again. Or, you know, buying some more down here or doing both. And that's true for, you know, I've found it true for about 2 weeks on a daily. You know, the equivalent on a weekly would be, what is that about? It's 10 days on a daily. The weekly is, I think it's like 6 to 8 bars max. Excuse me, 10 bars here, 3 to 4 bars over there. But that a lot of times that's what I do if I'm trying to trade something for a long period of time. All right, back to this. This one. Yeah, we talked about this already. Okay, let's go to the questions. Oh, there was this trade that Scotty, who didn't join us today, did. I wanted to show something here. So you all got the email. I'm not going to go over the email that much, but he was talking about this short, and it was on this day that he shorted it. And the short was, I think he put it on towards the top, 978. Traded to 10 that day. And he ended up covering and making money. And at the time, these green zones were down here. And that's what he was talking about. The thing I was wanting to bring up is don't use just your zones, right, as your tells. They're good because they tell you where people should come back in. But there's other things you can look at. For example, in this particular chart, this whole area right here is kind of a key area, right, with that swing point low. And this bar here, that was, I don't know if it was wide price spread, but it was fairly significant. But what was really significant, so that's one thing, but what was really significant when you look across here is look at this bar here. Right, that bar has big volume, wide price spread. Those are the most important bars. And look at where it goes. You're right, this thing went right to it. And so that was what I would have been keying on if I was shorting it. I would definitely be shooting for that bar, right, on the way down. And I would do the same thing he did. I would look right here to take partial profits and then shoot for this with the rest. And so the scaling in, scaling out, a lot of times is about that. You find something of significance, the first sign of it. You see if you can get through it. You take some as you hit it. And then you see if you can get the extension to whatever it is you're really shooting for. And if you're doing it that way, you end up putting some money in your pocket, and then you try to put the most money in your pocket at the next level. And in his case, he was actually trading against the trend. And so you almost have to do that every time you trade against the trend. Trading against the trend is about taking what you can get when you can get it. You're right. Anything that's significant, you have to trade into those spots and get out. You don't stick around. That was what I wanted to talk about with that example. TLT. Okay. Let's talk about TLT. There was a question on it. Let me grab that chart. This is our daily. The weekly. And let's see what the question was. Okay, so the question is, all time zones show no red resistance. Okay, can you hear me again? Okay. Okay, so TLT, no red bars, right? And that's because there's nothing up here. I'm actually a little surprised. Oh, no wonder I'm on the wrong one here. Hang on a second. When I use presentation assistance, it messes with my cache, and I have to clear my cache after a while. So there, now we can see it. Yeah, so there's nothing. Well, still, I'm a little surprised. I would have thought the algorithm didn't do very well. It should have found this as resistance right there. That would be the only place. But you don't have it here or here or here in these two, because that makes sense. Here, that really is resistance up there, and the algorithms didn't find it. Okay. 0 just means these go from a scale of 0 to 1. If they show up here, they were significant, or they wouldn't be here. 1 is the best you can get, and they're usually, I think, in increments of 15, 25. I think they can be like 50, 75, and $1, 1. The fact that it's 0 means it's just less significant than 15. Actually, do it by time frame. So this is the most significant on this time frame. Right, it's got the highest number. The best you can get is that number. That number says that's the most. It should be very hard to break through that. And that's on this time frame. That's way down here. Right? That just says it has the most significance. And it's because it's a high volume, wide price spread bar, primarily. So the way these ranks tell you is like, that's the toughest one to break through. And then any number down to 0 becomes, less and less important, less and less difficult to break through. 0 is the easiest to break through. The fact that it's 0 just says, it didn't have wide price, it didn't have high volume combination, or it anchor bar, or wasn't close enough to the current price. Those are the main 4 factors. And when you have more of those factors all together, then it gets a higher number. If you don't, it doesn't get a higher number. And so that's really what those things are. As far as this chart, it's a very bullish chart, right? The problem is it's extended, but it looks to me like it is going to try to reach this top again. So if I were looking at this from a trade perspective, your risk reward is difficult to trade this long, and you certainly don't want to trade it short, because you'd be trading against the trend. And so, if you bought this thing, your target is 138.50. It's only $2 higher. What's your risk? Probably down to 30, at least down to 31 or 30, whatever the swing point highs low is. This bar here, 132.60, the low, and the high over here is 132.40, 132.90, 132.01. So you got to trade back to about 132. You got to risk 4 to gain 2. There's just not a trade. And you don't short it yet. There's no reason to short it yet. So, I don't know if there's much else to say. Yeah, it's a strong chart, but there's not a good setup to trade it. Cube tells you it's just young and it can continue for a long time. Now, if you think about it, as long as it doesn't break a swing point low, and we're looking at right now I'm looking at the daily. That swing point low is way down here.
this thing could trade, let's say, 20, 30 more bars in this range and never break that. And that's all this is telling you. That is young in its trend, and the probability of breaking a swing point low is not very high yet. Now, at some point, another swing point low could form at a higher price point, and probably will. And as this number increases, right, the probability of getting under that increases. And so these, this tells you it's young in its trend, another reason not to short it. But you need a risk reward that lets you short, lets you go long. Now, it could set up where, let's say, if I just look at this thing and I was just saying that, this area right here looks to be the most significant price area, in terms of risk, how much I would risk it. If this traded immediately down to right here, you could think about a trade long and using your stops back down underneath here somewhere, and you're shooting for that 38 number or 39 number. You know what I mean? Then it starts to make more sense. Where it is today, it doesn't, because you have too much to risk. And so these are good. They tell you want to be long, but you got to wait for the risk reward to set up to allow you to make that trade long. It would be a breakout on the long-term time frame. Now, it would also, and this is another thing I've been asked before, it would also be a breakout on the weekly and the daily from a long, long time ago. But those things that I can't see on the chart, I don't use those as quote-unquote multiple breakouts on multiple time frames. If it hasn't happened close enough together, to where they're still on my charts, then I don't view it that way. Otherwise, any breakout on the monthly would be multiple time frames, right? And so, yeah, it would be a breakout, but it would only be on the monthly. Now, it could set up differently. Let's take a weekly. It could set up to where this ends up being a swing point high. Let's just say this ends up being a swing point high after 6 more weeks. Okay? And then it just like powers higher and breaks them both at the same time. Then you would have a break on multiple time frames, and the probabilities would shift to where it should try to continue for 2 to 3 bars on the monthly. Retest, regen, 6 candles. It's always 6 candles in terms of changing the probability. So the question here is, do you, when you get a retest regen, is it always 6 candles in terms of the time frame where it increases its probability? And the answer is yes. So this here, when it broke right there, well, it's already tested. It tested on the very next bar. We'd have to find another example, like anyway, if it goes more than 6, it's always 6. And so you start counting the breakouts here, 1 bar, 2 bars, and you keep going. If it doesn't come back within 6, then your probabilities are much higher that it's going to regen versus if it does come back within 6. This is interesting. He found this or noticed this. When I did the research, there was a question here about the 5th candle. Sometimes it looks like 5th may be good. When I did the research and came up with the 6 number, both in terms of trend qualification, right? In terms of, when do you say a trend transitions? And then also in terms of retest regen probabilities, the 5 and 6 numbers were close. As I do with everything else, I try to be more conservative, so I use 6. So 6 was slightly better, more cases than not. But 6 is also a more conservative approach. In other words, I won't transition my trend unless I get 6 bars. I don't count the retest regen higher probability unless I get 6 bars. So the observation here, 5 seems to work. Well, yeah, it does actually. And it works not as much, but almost as much. But 6 is what I use because, again, I always took the conservative case. And he's asking about wick extension. Yeah, I always use whatever the bar is. And so the question of, like take this swing point high here. When as soon as we get over this, which we just did, the next bar, if it's up or up sideways or whatever, I'm concerned about touching the top of the swing point. Just the top, whatever that price is. In this case, it's 135.25. If it comes and hits 135.25 on the dot, that's a test. And it's within 6 bars or after or whatever. That's a test. It came to the same price point, either could or couldn't get into it. It's a test, and that's a retest. And he's going from my book here, and I'm using different examples than my book. Second week in March. Yeah, I just did to count the candles earlier, so hopefully that takes care of this one. This question. Does going from bull to bear to sideways mean you will trade a range? No. Ranges, if you look at I think the third book, ranges happen, and the goal was a good example. They typically happen after some fast extension. Like this one. Yeah. Range is typically set up when you get and actually this was much better on the daily. Let me get this time frame. This is February 8th. So let me go back to the daily. And it's going to be off the chart, but February 8th was back here. And the blow-off move, hang on just a second. Let me get it up here. I can't think of another example right now other than gold having done this. And I put this on the weekly again. So the top of this on the weekly was 120.84. If you were on the daily, there was a huge bar up on this week, and that bar held price all the way up until here. Right? It actually tested over it a couple times on the daily, fell back in it, but even here you can see it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks before it actually really broke out. And even then, it came right back into it. Right, tested it again, now it broke out again. We're going on almost 16 weeks now after this first thrust. The thrust up or down with some sort of extreme volume, especially a wide price spread bar, which it was on the gold back then. If you have your other charts up, you could see it. If you have, ones that are more than 60 days, that usually defines a trend, a sideways trend on that time frame. And I remember actually when I did the shows back then, I even talked about that, and I think I've done them on the videos for members. That gold back then, I said, oh, this thing's going sideways for a while, and you want to buy. Oh, and that's the other thing that's important on a sideways trend. If you get this kind of an extension to the top side and it sets up the sideways trend, you really want to play it directionally, just one direction, that's up, because the up is going to be the way you want to trade it. You don't want to short. You just want to buy anything near the bottom. It's a one-way trade. And if it was doing it on the downside, it'd be the same. Now, sometimes these things will form sideways trends. And you see me, this is not a good example, but they'll form sideways trends without these blow-offs. Those are two-way. You can trade them both ways. Okay, that's that. Okay, volume. Well, yeah, you pay attention. The question is to pay attention to volume on a daily, sure. Minute candles, sure. On a minute candles, though, if you know, I think minutes way too small. I'd do 5 minutes at most. But if you're trading intraday, and we'll do this next week, once the day gets started, the first part of the day, the volume's going to be much higher the first hour and a half and the last hour and a half than it is all during the day. Matter of fact, it's about a third, and a third. First half hour, last half hour, about the same. The rest of the day, about the same overall, most cases. So you can't take and compare a volume in the middle of the day with one at the beginning of the day. And you'll see that when we do it Thursday. So intraday, it's different. When we're doing it here on dailies, they're all the same. You always look at volume and compare it when you're trying to make a tell. And so if I'm looking at gold and I see this big volume reversal, it did two things. It left volume at the top, which is one of the concepts we were going to cover today, which says it's probably going to go back up there eventually. It also was wide price spread, which says it's probably going to be a range for some time, with some juts underneath it, maybe over it, right? But still, on this time frame, it's sideways now for a while, most likely. Again, how long? 10 bars, 15 bars. It can go for a while. Daily candles, powerful as the weekly, monthly. The volume on the dailies, again, you just have to view it in the context of what happened across all the charts. So if I'm looking at gold and I see this huge volume here, is the volume huge over here? Well, it's big, but it's not huge. So, I don't think of this as necessarily stopping, gold for a long period of time, a weekly time frame. Whereas here, yeah, it probably is going to stop it for a few days, a couple weeks, maybe 3 weeks, and keep it in this general price area probably. So hopefully that answers that question. Red arrows, why are they pointing up, down, sideways? Yeah, red is suspect. The swing point it broke, it had less volume than the swing point. The green, it had more volume than the swing point it broke. The sideways, same thing, except for now it was just transitioning trend from bullish. So anytime you go from bullish, the next thing you go to is sideways, right? Because you only got three: bullish, sideways, bearish. When I'm bullish, I have to go to sideways next, and then I can go to bearish, which is the down arrow. And so it's always a transition, one then the other, and one then the other. Or of course you can go here and then back there, but it's you have to go through sideways. It's the transition from bullish to bearish. So it doesn't mean you will go bearish, but it just means you transition from one to the other. Why don't all the charts have these? They should, if in fact it broke a swing point. So if a swing point breaks, the chart should get an arrow one way or the other, even if it's reaffirmation, like here, right? This one reaffirms that one. Anchor bars. I already did that, so I'm going to leave that and assume I got it good enough. Fibonacci retraces. I don't use anything but what you see on my charts, which is horizontal lines. Am I aware of them? Sure. You know, I mean, I could probably point out and you guys could check me, but if I go from here to there, I can assume about a third is there, a third is here, the 50 is about there. I can see them without having them. And I know people trade off of them. And so, yeah, I know they're there. I don't have them on my charts, though. Do I use them? Not really. Use CMG as an example how to get in and out over 1 to 3 days. Let's do this when we do the trading on Thursday, because this is really intraday. If you were watching me this week, I traded CMG, and I think we talked about it quite a bit on the other show, Monday show. I ended up selling out on a stop out, and I was forcing it to trade higher. I still like it, and I still may trade it again, but it didn't close over the weekly low, and that was why I left it. This low was 399, if I remember, 399.14. We closed at 397.27. So as you see, it got a bearish reaffirmation trend. Are we near a bottom? Probably. Can I stay in a position that just broke down farther, in terms of transitions? No, I can't do that. That's against my rules. So I come out of it, I wait, I see it set up again, I try it again if I want to. Otherwise, I just forget it and find another chart. Had it stayed over it, I would have stayed with it, right? Because it would have done exactly what I wanted, but it didn't. And so sometimes, the trade just doesn't end up the way you want it. Take a series of charts, breakouts. Why are we going to be looking for a retrace? Follow them. Okay, I did this. Hopefully that is understood now. The ATR. We kind of touched on the MTTF sectors, general market already. I think I probably covered those reasonably well. The retrace. Usually what's going to happen if something breaks out, let's just use CMG here. And let's use this breakdown here. This is a breakout, right? Now, I don't know. Let's see if CMG was breaking out on multiple time frames at the time. Put this on a monthly. And this was November 9th. It was. Or was it? No, it already broke right here. So no, it wasn't on the monthly. But independent of that, how do I know if it's going to continue? Well, I don't. What I know is what it shouldn't do. And what it shouldn't do is it shouldn't get back over that low's high. So if I end up buying the breakout or some retrace in here, right, with the expectation that it's going to go down, I put my stops up here, right over it somewhere. And I would go down to the daily to find them. And then I just simply let it go and see what it does, right? See if it continues down and I get a great trade, or if it comes back up here, I stop out. Now what I can also do is if I'm trading intermediate term time frame weekly, I could walk over to the daily, and let's take the live example here now, which is right here, this break, right? So let's just say I shorted it again here. And on the monthly, this may break this month. You see this? Potentially. So that's a potential. We're not through with the month yet. So the break potentially is this could go farther. Now let's put it on the daily. And on the daily, okay, now on the daily, I remember now, this actually had a hammer reversal right there. So let's say I'm shorting this. Let's just say for whatever reason, I think this is a short, and I'm going to take the short because I think that, intermediate long term is going to go down even more. To tell me, and this is pure candlestick, this really isn't neoclassical, to tell me this trade's probably going to work, this low should not be violated if it's bullish. And that's just a candlestick thing. A hammer reversal on lighter volume, the ideal entry point is the low of the prior bar. That's the ideal entry point. And it should not violate the low of the candle that did the hammer reversal. If it does, you have to stop out. So if I'm taking the short position, I want to see this happen. I want to see it trade down here. What am I willing to give it? Well, on the daily, I could use a very tight stop here, or I could be thinking this big bar, which is the safer stop. So I would maybe have my stops up here. Now, I'm risking a lot, right? So I've got to be thinking intermediate long-term breakdown, with a target much lower, and this is all hypothetical. But you can kind of see how I'm looking at this thing. I want to see this happen. If I don't see it happen pretty soon, maybe I take part of my position off and leave the rest of it on with stop up here. Again, you can make all kinds of trading plans. You just have to know what's significant, what you're looking for, and maybe I give this a few bars here before I stop out if it gets over this, or maybe I have two stops, partial there, partial up here. Maybe that's how you trade it. You can come up with different scenarios. The fact that it broke on the weekly and did not hold says that it's probably going to try to continue down at some point. You really didn't want to see that if you were bullish. And it's just now a question of where can you short it again if you're going to. And on the daily, if I were shorting it again, I'd probably wait for this price point right there. And I'd put my stops up here. That's how I'd trade it. And try to get the breakdown on the monthly. Because it didn't do what I wanted on this trade on the weekly. And again, I'm going against the trend, so it has to do what I want or I don't stick around. For the benefit of the replay is, do I use fixed stops or trailing stops? I use both. It depends on what I'm doing. And this was all in the context, the question of the context of a longer term trade, not a shorter term trade, so like intermediate or long term. In both cases, I could use either one. I'm okay with both. It depends on the trade. As far as do I use fixed or mental, because I'm around the screens all the time and because I have the discipline to stop out, I use mental almost all the time. I don't use fixed stops. So that's because the charts change, and a lot of times I'm interpreting the charts as we're going. Now, if you're long-term trading, like take Chipotle, and let's say somebody bought it here. You do want to stop out underneath here. But, personally for me, and this one's a clear-cut example, you could have a hard stop on this one. But you have to give it just a little bit. I would take the ATR underneath this thing, the 20% off the ATR. And, Chipotle is probably $2 or $3 at least, probably 4 or 5 this is on a daily. It's probably a couple dollars. So my stop might be 382. As a matter of fact, I think that was about where my stop was initially when I entered this. If you're doing intermediate term trend trading, you would want to use your ATR off the weekly. If you're, if you're trying to trade it on the intermediate term time frame I would use my weekly ATR based on whatever I'm trying to do there. So if I were using this hammer reversal or this little doji here on the weekly, and let's just say it didn't break, let's say it held, and I wanted to give it more room, I would use the ATR off the weekly, not the daily. And that one's going to be bigger. And so I typically trade off the intermediate term time frame. I almost never trade off the monthly. I use the monthly for trend or trend reversal, but I typically don't base my charts off of monthly. I mean, that's the only time I do that is like when I have, say, markets typically move up, right? They move up about 62% of the time. Sideways to up. Most of the time they're going, inching their way higher somehow. If you're long-term trading and you want to stay in it, that's why a lot of these folks use, what is it, the moving average crossovers, and they use longer-term moving averages, maybe 200-day and a 50-day, to decide whether to stay into something. And they're using that as kind of a trailing stop, basically. The ideal there being that, you want to give it enough room to where you stay in it long enough. And if you're really doing, say, the general market or a stock, and you think you're going to stay in it, like, I was talking about gold earlier, and you think you're going to stay in it, you could do something like that. But my preference is really to use bars of significance and then some sort of an ATR off of them. And usually I'm always managing things closer in my own personal trading to where I don't use the ATRs off of monthlies for that. I'm usually using the intermediate term time frame. And like I told you with gold earlier, I'm going to be trading in and out of it, so I'm probably not going to, or I'm trading against it. I'm, with a hedge trade, I'm probably not going to be as worried about trying to stop out if I'm wrong, but instead using the flow of the market to better my positions as I build them, because it takes a long time to build a position that you want. It took me, I don't know, 2 or 3 months now to even get it to this size. Even with the conviction that I thought that it was a good trade. So I don't use the monthly ATR. Wide range bars, yeah, and I covered that for you, Bob. Is regeneration. Yeah, the regeneration, the question here is, when do you know it's regenerating? And we have to go to something shorter. Here's the daily. So if I take a retest regen, sorry, I'm trying to find a case. Okay, so here's a case right there. So this has a break, this red arrow. This broke something at the time it was on the chart, probably over here. So there was a swing point low over here somewhere. I did the wrong one. I want the swing point low. I'm not finding an example on this one. I have to go to some other chart. Let's go to, let me think of something that's probably had it. Maybe Alta. One of the few high flyers that are still flying. Here's one. So the case we're trying to find is, when did we break a swing point low or come back to do a retest regen after a break? In this case, it's a bearish retest regen. So this is the swing point low. We broke it here, and we immediately come back to test it. When does this regenerate to the downside? It would regenerate to the downside when this swing point low is undercut, again, after retesting, and ideally you get one extra bar. So you want to see it get under this low of the low and stay under it for at least one bar, but ideally 2 bars. The bar it gets under it and the next bar. If it does that, ideally it's, at that point it should be regenerating to the downside. If it doesn't, it's not. And in this case it didn't, right? And eventually broke out and continued on. So I think that hopefully answers this. And the 6 bars thing just is, if I break it, how long does it take to come back? If it's more than 6 bars, your odds go up greatly that it will regenerate in the direction of the trend. In other words, in the direction of the break, which in this case was a swing point low that was broken, so that's down. If you're within 6 bars, the odds are much less. And it also, and I never did the study, I don't remember that I have any data on this, but it also, I'm sure, depends on the trend, the bigger trend. Like if the weekly and the monthly are up, the probabilities of it regenerating to the downside is less, right? Because there's more noise on the daily time frame. And so you get the movement around, but the longer term stuff is still up. And that's why I was saying earlier, I usually use intermediate term trends for almost everything I do, except for day trade type stuff, because the intermediates have less noise. And so I like to look and see intermediate first. As a matter of fact, when I use the tools, and I'll show you this, when I come to the tools and I pull up, say, let's take sector trends, and we'll just put Alta in here. So sector trends gives you, as best as it can, it gives you all the stocks in a particular sector. And so in this sector, XLY and specialty retail, Alta shows up in here somewhere. What I typically do here is I come in, if I see Alta strong, or let's say I see earnings from Alta and they blow out of the water, right? They do great. I'll come in and I'll put Alta in and I'll click here on the intermediate. And in this case, if it's bullish, I'll go down and look for the bullish ones. And then I'll glance to see if they're bullish on the short term as well, or maybe sideways. And then I'll click those that are. Like these, and once I get them, right, and that one wasn't, once I get them, then I'll go up here and say, all right, maybe it's show the display the ones I selected, and then it's going to pop up all those charts so that I can flip through them all one by one, and I can find other strong stocks and quickly scan them all if I'm looking for something, right, in that sector. So that's a good way to do that, right, and to find other stocks that are strong. Use the unreleased 1 bar at a time feature. Maybe you can get something from your... Yeah, this will be released at some point, but it's not so much the program. The program is pretty much in effect. It's switching over to a different data vendor, and I haven't perfected the automatic drawing of the zones yet on the new data source. That's what's the holdup. So, and I'm actually trying to improve the zones while I'm doing it. So I would think this happens within, I've thought for a long time I'd have it out soon, but I would think this happens pretty soon. So I will release it at some point. As soon as I feel like the zones get drawn right with the new data vendor. Yeah, so breakouts, retracements. Yeah, unfortunately, I'm not going to have time to do all of these things. I'll do as I think Thursday will be a good example because I'll be able to do some of this live with you. So hopefully Thursday's session will do this. When I do the individual mentoring, with the individual mentoring, I do this a lot, and not so much every morning now. I have a call with the two people that I've mentored, and we go over what we think are the best trades for that day. Uh, potential trades, whether they get mentioned in any of the rooms or just amongst us. Um, this is kind of what we do, using Stock Monitor and stuff. And let's okay. Maybe now's the time. If it came back good now, maybe now's the time to take a break. And then what I'd like to do real quickly when I come back is show you each of these tools and just give you a quick understanding of how to use them and what to use them. Not detailed, but just general, because they have different purposes. And then I'll finish these, and then I'll go back and finish those other concepts I wanted to make sure and cover. So sorry for the delay of getting going here, but let's come back in about, and I'll just leave this up. I'm not going to stop it. I'll be back in 8 minutes? So 4:30 my time. So, with the question being, does it go to bullish, bearish side, bullish, sideways, bearish, and vice versa? What I was trying to say is that it can't go to bearish from bullish unless it goes through sideways. And you can't go from bearish to bullish without first going to sideways. So sideways is always in the middle. You can certainly go bearish, sideways, bearish, or bullish, sideways, bullish, right? In other words, you take a pause and then you continue. And that's probably the more normal case. Unless the chart didn't get drawn right, you should see. Well, actually, let me take it back. Sometimes you'll see. Yeah, I was about to tell you the case that it happens. Let's see what this one looks like. Yeah, yeah, and the reason for this is, and this is what I was going to actually just tell you theoretically, but here's the practical. Swing point low, swing point low. This broke both of them. And so it actually went from bullish, right, this bullish here, it actually went from bullish to sideways to bearish, all in one move. That's what it did. And so sometimes it will look like that, but in fact it went sideways on that one and then bearish on that one in one bar. Sure. Okay, I was talking about showing the tools. I think everybody knows what the watch list is. Now the watch list is kind of a glue, kind of holds all the other tools together. And in many cases, you can move stuff. You can add stuff to an existing watch list. To create a watch list, you just come up here and type a name in, right, and then save it. So whatever I might want to call it, TT. I just stick it in there. Say, and I can make it private or shared. Save it, and then I have that watch list. To add stuff to it, I just type it in here. And put a space in between them. Or I can bring it from a file. So if I have a file that has symbols, spaces, or commas in between them, this thing will suck them in. So you just, add symbols, You browse, find your file, right, wherever it may be, import it. If you have notes, you can actually import those as well into here, and then you got it. If you wanted to export it, you just do this. It looks like Chuck got dropped, so let me add him back in. Everybody got dropped. Wonder why that happened. Yeah, it looks like I dropped folks somehow, so I'm adding y'all back in. And Walter. Two of them couldn't be added. Huh. Alright, I'll wait until they try to call. So that's the watch list. It's fairly self-explanatory. This is freeform. A lot of times I'll put just general notes in here for myself, and then to save it, just update the notes anytime you make a change. But that's the watch list is kind of a glue, holds everything else together. Trading cube we've gone over quite a bit, so I'm not going to go over it again. Charts we've gone over quite a bit. Stock monitor, trading signals, exact same thing, except trading signals only fires if 80% of the criterion is met. And so this is a idea generation mechanism. And so the way I use it is I'm thinking about the market from the general market perspective. And so if the general market is, let's say it's bullish, then I want to be looking for bullish breakouts, potential or actual retraces. And I want to just go find those. And so if I click on that, it will filter it down to just those. And then I can either view all the charts if there's more than one, or I can view, the ones I select. Now there's some additional information here. You can also filter things. Like a lot of times I don't want to see fixed income stuff. And so no fixed income. And if I do that and I select, say, bullish breakouts, then this will filter out anything that's in the TLT in that sector. Anything that you see here, you can filter on here. So, it's kind of flexible, and then you can, once you do this, you can save it, give it a name and save it, and then you can use it in the future. A lot of times I only look at stocks that are greater than $5 and volume that's more than 1 million shares on average. And then it will filter down to just those. So again, you could do, this is ideal generation. Once you generate ideas, like let's say that we find these and we think these are great, these three. If we select a watch list, and I'll just put it on temp, and then add that to the watch list. Those three symbols get added to my watch list temp. So now I have a temp watch list. Let me go to it. And if I go to that watch list, And I forgot those three symbols, but whatever they were, they should have got added here, like there's one of them. Now that I have it, I can monitor it, right? Because let's just look at it and see what it looks like. So this is a bearish breakout, okay? So now that I have it on this watch list, I can monitor it. It may be ready to short, in this case right here, or it may be that I may want it to do a retest regen or something before I short it. And if that were the case, then I would monitor it, stock monitor. And this would alarm me the next time it gets to something that may be something I want to trigger on. And again, same signals, but stock monitor will fire without the 80% rule. What are the 80%? If you go to the help, it will tell you what they all are, right? These are the things that have to fire for the trading signals to fire. Stock monitor, it will do it on any of the retraces or breakouts, potential or actual. So that's the big difference between those two. One is to find stuff, trading signals. The other is to monitor it. These two are for finding things also. And I already showed you sector trends with the one that we put in. Trading Cube Scanner also is the same idea of finding things. I have one called Momentary Weakness. What this does is it looks for stocks that meet the criterion that I set in terms of trend on these time frames, on the stock, the sector, or the market. And I can also put a qualifier of the mean time to failure. If I put less than 50, which I've done here, I'm saying I want something that has moved, but it's still kind of young, right? It's not extended yet. And I want that on the bearish, and I want these two on the bullish on the stock on these time frames. And everything else I don't care. And it will go through, and what I'm saying is I want something that's bullish and young on the long and intermediate, but it's got a bearish on the short term. So in other words, if I were looking at this chart, actually let's pull one up. Let's just grab one of these. If I'm looking on this chart, right, notice that this chart is strong and strong. And then on this time frame, it's pulling back. If I expect it to continue long term, this is momentary short-term weakness that could potentially be bought. And so this may be a way to find something that's going to come into maybe an area that I want to buy it, like right there. And which would be right in here maybe. You see how they line up? That might be a spot I want to think about it. So once I find that, I could click this and I could add it to my watch list and monitor it. So again, you can think of ways that you might want to find trend and how extended it is, and use that to find stocks that you want to buy or sell. Idea generations. Okay? So that's basically the tools. This we already did. So there was a question about scaling in and out. And I kind of talked about that already when I was doing gold, about scaling in and out over time. Again, we'll see this in action when we do it Thursday live. So I'll just reserve the further discussion until then. And then the rules, I kind of already went over those. So I think that was all the questions that y'all had for me. So I'm going to go back to the doc and let's see if I can, right here. Whoops. That's the wrong one. Let me get the right one. Do you hear me? Okay, I wasn't talking, but it probably went away before. Here's the one I want. Open it with the right tool. Ah. Okay, so to finish up what I was wanting to talk about today was price projections, reversals, magnets, these things. And again, the idea of scale in and out all the time. And usually I'm looking at 2 or 3 spots to do things on almost all my trades. So let's start with price projections. And let's grab a chart that actually this one's not bad. There's different types of price projections, just 2. There's range expansion and contraction, range expansion. And now this is more of something that you do eyeballing it. Then you do, you know, I mean, this is not like rocket science stuff. It's like I eyeball it, and I want, when I'm doing a range expansion, I want the ranges to be about the same size. So when I look at this, I can kind of see, and what I'm looking for is some bar of significance, this one, and where that bar was respected many times. You see how those came down to it, and these got a little under it, but they kind of held it. And so that area becomes kind of like, okay, that's a pretty good bottom of a floor. If you think about a floor, it's kind of a floor there. And on the converse side, this up here is kind of like a ceiling, you know, that area up there. And so, you know, that's kind of a floor and a ceiling. And so I can kind of divide them up to where about the same size. And my range expansion, ideally, just like this bar has something significant, the bottom of this one should have something significant too, which it does. And so once I get underneath the floor of the first floor, the higher floor, and get into the lower floor for a couple of bars, then I can expect it to try and trade to the bottom of the range. Doesn't mean it will, but that's a good target. And I've got this bar's top, and it's getting a little messy, so I'll just redraw. But in this range here, I have this bar's top. Well, that's not going to work that small. But I have this bar's top and that bar's bottom as targets. So right there and there. I had this floor, right, that I've broken under here, right, and now I've stayed under it. So now I'm going to try to trade down into either this, which it's almost there already, right? But more likely, try to trade down to the bottom. And many times there will be something just like this that has significance, this bar, wide price spread bar, right? High volume as well, actually, volume is about there. High volume, wide price spread. It'll probably try to trade to this, bounce off of that. If it can't get above it, then it will try to trade to the bottom of the next one. And so the range expansion, right, is a good way of doing price projection, up or down. So on the up case, if I look over here, I don't see a good one there. Here's a pretty good one here. Looks like about there. About there. And about there. You see that? They're almost all the same. And so if I were looking for range expansion when this broke out, I would be looking for a trade to be about the same width as this up here. And it didn't quite get to it. It was almost. So price projections, that's the main one, or that's one of the two. The other one is ABCD structures. And just a note, these are not neoclassical. These are things other people have done before me. But on ABCD structures, the way you find them is you just find, if you're doing a bullish one, you just find some low, right, where you get an expansion up to some high. And what you need to know for the B point, this is the A point down here, right? To get a B point, you need some high, and then you need a lower high, a lower low on the next bar. Once you get that, okay, so you get an expansion up. Once you get a lower low, lower high on the very next bar, that becomes a B point. The bar above it, right? The high. That's a B. Now the C point is the lowest bar down before you get a higher high, higher low. That becomes your C point. And then the size of this bar, a 1-to-1 structure, the size of that bar should be the size of this bar. And so here we didn't get to it, but eventually we did over here. And a lot of times you can get nested ABCD structures. So in other words, like here, there to there, there, and then up again. You see how they can nest, and there's another one here. And so ABCD structures can be another way to measure and project. I don't treat any of these things as totally exact. Some people do. I'm more like a government worker. If you're in the ballpark, that's good enough. And so I don't try to get it, to the penny. I just want to know the general area it's trying to get to. And, I think the markets are too sloppy to think about it to the penny. So that's price projections. The main reversals are of two types. One is a 2-bar reversal, which is the better of the two. And there's one on this chart. right here. The way you define a 2-bar reversal is you get one of those angles of ascent that we were talking about that's extremely steep. And so you make a large move in price percentage-wise. As it goes up, you go over, back under, right? Closes under the prior bar, has less volume. That says that this should not trade back over this high, and more than likely the next bar is going to be sideways to down at best. And more than likely, not more than likely, but it can mean that you're going to get a reversal. And that's what you're trading for. So essentially you have one bar free, and this is true on a weekly and a monthly too. You have one bar that you can use as the entry point, right, on the reversal. So if this thing reversed, the ideal entry is the prior bar's high, and this would actually got right back to it. Your stop's up here, right, and you're actually trading for something that's a reversal, and you don't know how far it's going to go. Now, this was extremely strong, so it's going to take it a while, but it did trade back to a swing point high. Eventually, right, gave you a decent percentage-wise, a pretty good move. That's a 2-bar, and that's the better of the two cases. The weaker of the two cases, reversal, is the same thing, just not as extended. So if this wasn't as extended here, that would have been just a over-under, or an under-over is the opposite case. And both of these, they work both ways. The one that you can bank on for a trade is the 2-bar. This is the ideal one. Well, big, fast move, reversal. Now, if you're in a stock, you can simply use it as a place to tell you to take some profits. You don't have to try to use it to short the stock. Matter of fact, it's not really what you want to do most of the time. You want to use it for profit taking, because it's probably reversed, and you also use it for timing the next entry back in. So you get up here, you reverse, you wait for the retest, regen, right, over the 6 bars, and you get a spike back up on it. Actually, let's see what that is. That top was 1531, 1550, 1550, didn't quite get to it. It did here, and you got a little bump up. So didn't quite give you what you wanted here, in terms of getting the retest so that you could enter. Because ideally I like to see those enter, touch them. Those are reversals. The only other reversal is the candles. One is the one we already looked at, which is the hammer reversal. And I don't remember what chart we were looking at. We just looked at a hammer reversal on something. Oh, it was on CMG. The hammer reversal. And that is just where you go under, back over, less volume. Ideally after some sort of a other signal, like here, ABCD down, right? And it more than extended down. That's a good, reversal signal to try to, trade the other way if you want. And these are timing trades if you're trying to, go against the trend. If you're short, it's a good place to take your profits. And on the top side, it's the opposite candle, which is a hanging man, and this is one here. This one here. Now, this really just did a test of this top and a test of this over here. But if you think about what the bar is telling you, this is the reason I like candles. The buyers from here to here, the buyers were mostly in control. But when they got to this price point, whether it was because of all this up here or something else, they lost control because the way the candle looks, it traded up to here but couldn't hold, and it closed it way down towards the bottom. A hanging man, the same principle applies, just the opposite. Your ideal entry is there, whatever it was you were testing. Ideally it's the prior bar, but in this case it wasn't. And the stop is just over it. And so if you're trading, if you were trading Chipotle short and it gets up here and does a hanging man, that's an opportunity, especially if it lines up with something else, like in this case, 469.98. Yeah, it didn't quite get to the highs. Neoclassically, there's nothing here that I would be keying on other than the fact that it's up into the highs, but didn't quite get there. Maybe it got to this one actually. Not quite, 470. So hanging man is the other one, reversal. And then the magnets we talked about too, where like this one, a high volume low. Especially on the lows, when you're going bearish. When you get this kind of volume expansion at a low, surely you can bounce. A lot of times it's exhaustion that leads to the bounce. But more often than not, especially when it comes back and you see here where it breaks underneath this little congestion area, which is a swing point low, and it breaks down. Once it starts touching back into the top of this bar, and this bar actually extends from there. Let me clean it up and do it again. The bar extends from right here. That was the prior low. And so it really was a move from there to there. Once it gets back into it, odds are it's going to try to get to the bottom. It's going to be magnetized to the bottom. And that happens over and over and over. And it does the same thing on the top when you have a high volume top. Like if there was one, I don't see one here. That is by itself. In other words, nothing got underneath it on the next bar or two. It just went back the other way. Those things almost always come back and they test them eventually, up and down. So those are magnets. Okay, I think I've covered the majority of what I wanted to cover today. I mean, there's some more details probably here, but I think I've given you the gist of the whole system. Even though there's not that many faucets to it, you can see it's very methodical, and it doesn't leave a lot of gray. Sure, there's some things that, and when you actually have gray, like the Apple chart we looked at, when you have that gray, to where there's a conflicting signal, there's a bearish retest in regen and a bullish retest regen on the same time frame, why bother? Just go find something else. Get something to where it's cleaner. The cleaner the read, the better. I want something very clean when I'm trading as best I can, no matter what I'm trying to do with it. I don't want a lot of interference from other time frames or even from the existing, especially the existing time frame, because that just says it's confusion and you don't know what it's going to do, and it doesn't know what it's going to do. Okay. Well, maybe this is a good spot to drop. I think I've covered almost everything I wanted to today. So let me end today's session. I think I'm going to experiment for next Thursday. I may use just a live feed um, with YouTube or something instead of having a voice from y'all and y'all could actually type something in. I'll look at it and see. I've done that a couple times before. It was cleaner than this. I didn't have as many problems. But Thursday, we're going to take live charts. Let me just set up what I'm going to do. Wednesday evening, I will monitor, a few charts, general markets, and I will find those things that look like they have the potential to day trade the next day. What I will do is I will go through and mark those charts up for you before we start the day. And then we will interpret what's happening on those 2 or 3 instruments Thursday morning and look for trades to set up on a very short-term time frame, 5-minute charts, 15 and 30s. Same principles, just on something that we can see it play out very quickly. And we can do that and see how those charts line up. Now, I was going to do it at the end of the day. I typically trade the beginnings of the days, not the ends of the days. But, because of the time frame here and when most people can be available, we'll end up trading kind of the end of the day. So that's what I'm going to do. And I'll send those charts to you that morning. And then we'll try to see if there's some live trades we can make, and we can interpret that day kind of live together. Okay, so that's the plan for Thursday. All right. So I guess I'll leave it at that. I'll save this tape, and you can review the tape. The tape quality, I think, will be better, at least the voice. And then we'll pick it up again on Thursday. Thank you all. Take care.